we now move to the income approach to valuation. In dealing with this, we're really getting to the end of the major approaches. So the three major approaches you need to be comfortable with, to have a good understanding of, are the comparable sales approach or the sales approach, the cost approach, and now the income approach. This income approach, you'll find, also relies to a certain extent on a fair bit of market data. And so we're going to have to look at this whole question of, is the income approach really just a variant of the comparable sales approach? We're going to end up with the same difficulty we had with the cost approach, and that is that we do rely a fair bit on market data. And so does that make it a sales approach or something else? And the answer is, because our focus is something else, that's really what's going to define the method, even though we rely quite heavily on market data. Moreover, we're going to look at the way that the three approaches to valuation actually have considerable overlap. That's going to be drawn out far more in the study guide. But for the moment, I'd just like you to think about the way that when we do the cost approach, we are also interested in comparable sales, especially for the land. When we do the income approach, we're going to see that we're going to be interested in costs. In this case, we're going to be looking at operating costs rather than capital costs. But cost estimation and so on is also very important. And we're also going to be going to the market for our various bits of data, for rental data, to eventually calculate the yield. And so what we need to be aware of is that these three approaches are actually interrelated. Oh, and by the way, by the time you go back to the sales approach, which you might say, well, that's the bedrock, that's the base, why don't we simply use that all the time? You'll also find that when we do adjustment grids, we're really looking at cost issues. And to a certain extent, when we're looking at the most probable buyer, we are often considering things which are getting very close to some of the elements that are important in the income approach. And so the three approaches actually have a lot of overlap. Let's look now at more detail into the income approach itself.
This module really begins with a little bit of a recap, or rather taking further into depth, an idea that we first encountered in the first module. And that was that the first fact of property value is its rental value. And it's really from its rental value that you get its capital value, or its sale price. We look further in this module into the history of this particular idea. And we see that there has been a time in European history when property did not actually have a capital value or a sale price at all. And that was only about 500 years ago, back about a century or so before Shakespeare. That is because property wasn't bought and sold before about the year 1500, more or less. And because it was hardly ever bought or sold, sale price was simply irrelevant, despite rental value being extremely important. And in the study guide, we go further into looking at the way that rental value comes from the human value, the experiential value of land in the life of society. And that's important because it gives us the first idea that's important for this particular approach. And after all, it's the income approach ultimately, especially when you consider it a little bit broader than simply in dollar terms, that is responsible for the desirability of owning property in the first place. Another point which is made in the study guide is that land, like money, is not capital, even though in our part of history we often refer to both money and land as capital. And we go into the history of that confusion in the study guide. One of the odd things about the fact that these two very important and valuable things in our society are not capital, strictly speaking, is the curiosity of where yield rates come from, and for that matter interest rates and their relationship. Yield is the ratio between the income as rent divided by the value of the land. So yield is a simple percentage, and it's this ratio of the rent divided by the capital value. And in some ways it's similar to the interest rate on money, in that the interest payment you receive divided by the principal of a deposit or a loan gives you the rate of interest. Both of these rates ultimately are mysterious. We don't exactly know where they come from. They don't have some logical or scientific basis. We can observe them as being present, but they're present more as a social artifact. In other words, something which is simply a product of the doings of society, not as something that comes up as a result of some quantum of labour or quantum of something which is quantifiable. And this gives rise to what is an ongoing question, both in economics and in property valuation, and that is, what is the appropriate rate of profit, rate of interest, and in property, the yield to apply when you're going from a rental value to a capital value. And in the study guide, we look further at the similarities and linkages between money and land. This is very important because money and land are linked in our world, and especially since if interest rates fall, just give a little bit of thought to what that does to the price of property. Because land and money are very, very important assets in our economy. Let's move further now and look at property as an investment. If we're looking at getting into the mind of the most likely purchaser, which after all is where the valuer must delve to find the answer to the valuation problem, what we find is that property investment competes with other financial investments. In other words, as investor, I might have $500,000 to invest, and I'll be wondering whether to buy government bonds or shares in a company or maybe an item of property. And so the item of property must be able to be compared in some way and evaluated against these competing investments. And this is where yield is so useful, because yield gives you a rate of return which can be related to the rates of return on money loans and also on profits on business ventures. And so yield already is an attractive comparator of investment value. And so by using yield, we find that we're able to more readily understand property as an investment object. Now, if we know the yield that's operating in a particular property market, and we know the rent, we can get the capital value simply by dividing the rent, the return, the net operating income, by the yield. And that's exactly what the income approach is. Very, very simply, in this second last bullet point here, capital value, or the sale price of land, equals the return, as in the rent, divided by the yield. This means that we still have to go to the market to find the rental value of the property. We tend to do that by looking at comparable investment properties and what their rental value is likely to be, what we'd be able to rent them for, we'd lease them for. We also go to the market to find the yield. Nice thing about going to the market for these two factors, even though it appears to be a sales comparison approach, we don't have to go to exactly the same kinds of property to look at the yields. In fact, we don't have to go to properties which are so close to identical to look at the rental value either. All we have to do is ask the question, will this property rent for more or less than the property next door, across the road, or down the street? Where we're not looking at the property being physically comparable, but simply being similarly attractive in terms of its ability to attract rent. Likewise, in terms of yield, we can calculate the yield by looking at comparable properties which are currently tenanted, they've got leases, they're investment properties, and have also been recently sold. They don't have to be physically similar, and they don't even have to be that close. They have to be in the same submarket, but you can go further afield. So the advantage of this method is that it gives you an understanding of your submarket in terms of its investment performance, that's the yield. The yield does come from the market, so it uses comparable situations to a certain extent, but they don't have to be physically comparable. And so that gives you a lot more flexibility in terms of where your market evidence, where your analysis goes for its data. And likewise, the rents don't have to be quite so close either. The last thing about looking at how we apply this method is to look at the question of net versus gross analysis. Gross analysis, where you take the asking rent and you simply divide it by the sale price or the value of the land or the comparable lands to work out the yield. Net analysis is where you subtract from the gross rent, the total rent, the rent which is mentioned in the lease, you subtract from that all the operating costs that the owner has to pay before they get their net income from the property. That gives you a different value for the income and what we call the net operating income. We'll look at an example now. The example is taken from the residential market. Now, generally, the income approach is applied primarily to commercial properties, so offices, factory buildings, and things like that. Here we're going to be using the method in a residential situation. Now, it turns out that residential property, with the rising number of investment buyers, is starting to find applications for the income approach, even though traditionally for residential we use the comparable sales method because usually you don't think of it as income producing. However, I'm using this example largely so that it's something which is approachable. I think all of you, regardless of whether you're working in the industry or not, will be able to relate to. And I would like you to go out and do a little bit of a field study while you're studying this module and basically do your own investment analysis, your own income approach valuation by simply looking in the window of a local real estate agent to basically verify this and get a bit of a feel for it. And I'll be talking about that shortly. Okay, so here's the example. We have a property here in a suburb of Sydney that recently sold for $760,000 and currently is being advertised looking for a tenant, and they're asking for $460 a week in rent. Now, the Sydney market is such that it's very likely they're going to get their asking rent. There's very low vacancies at present, so there's a lot of demand. If we take $460 per week, convert that to an annual amount by multiplying by 52.2, we find that if you do the maths, and I recommend that you check this with your calculator, it suggests a gross yield of 3.16%. That's the ratio between $460 per week expressed annually, so multiplied by 52.2, divided by 760,000. When we look at the subject property in our example valuation, the subject property is being advertised for $500 a week. What we can do is convert the $500 a week, again by multiplying by 52.2 into its annual amount, and divide by the 3.16 that we've calculated from our comparable, and that gives us a gross capitalised value of $826,000. And if you go to the study guide, you'll find that there's a few extra dollars in there that we've rounded out of the slide here. Now, also in the study guide, we said, well, that's all fine. We now have established that the property should be worth about $826,000. We can walk away from that. However, the investor, because we really want to get into their mind to work out how they're looking at the thing, they're going to be considering the costs that are going to be involved in operating this investment. And in the study guide, we list those costs. And by the time you take the annual costs away from the annual revenue, that reduces the total revenue somewhat. And it reduces the yield from a gross yield of 3.16 to a net yield of a little bit over 2%. And again, if you go to the study guide, you'll find the maths is all laid out. Long and short of it is that by the time you apply that new net yield of about 2%, a little bit over 2%, to the net operating income, which is the net rent after you've taken away the costs on our subject property, capitalise that, you end up with a net capitalised value of $836,000. There's a little bit of a difference there. The differences come largely because of the different structure of the costs in the comparable properties and the subject property, and that's discussed in the study guide. In this case, the result is a little bit different. It might be more different, it might be less different. What it does do, it opens up the possibility for the valuer to look at a bit more detail, a bit more depth, and hopefully get a little bit more precision out of the result by a careful look at costs. This means that the valuer, taking the net capitalisation approach, which is the preferred approach, needs to be fairly competent at estimating operating costs. This then leads back to a similarity between the income approach and the cost approach. Remember, in the cost approach, it was important for the valuer to be able to make reliable cost estimates. However, in the cost approach, we're looking at estimating construction costs or capital costs. Here, the valuer needs to be able to estimate with sound reliability the operating costs associated with an investment. If you go to Whipple and look at the example in Whipple, which is a lovely example of a commercial income approach or income capitalisation approach, you'll find that that lays out the kind of costs that you're likely to find in operating a commercial property, an office building. And rather than reproduce that, I'd like you to read that. Okay, so that takes us to the end of the theory and the major points here. You can see that the method itself is fairly straightforward. The maths in it is delightfully simple. Simply divide the rent divided by the yield. It becomes a little bit more tricky when we start to look at costs, and taking that out, the maths is better developed in the study guide. You get most of your data from comparable sales and comparable circumstances. It's important for the valuer to be aware of the differences between markets and submarkets. It's also important for the valuer to be aware that different types of properties will have tendencies to have slightly different yields because sometimes of issues, local issues, such as obsolescence and depreciation issues. For instance, an older building will often have a higher yield than a younger building. And valuers might look at that and say, oh, that seems to be a bit upside down. As a student, you look at it. But in fact, it makes a little bit of sense because the rent is not going to change that much between an older building and a younger building. However, a shrewd investor looking at buying an older building knows that that older building is going to need major capital works in the not too distant future. What that means is that an investor will not be prepared to pay as much. And so in terms of looking at the yield, they'll be looking at a lower capital value because the older building is not worth as much. However, the rent is not that much lower. And so the big drop in the capital value compared to the small drop in the rental means that you have a higher yield. Developing a bit of a sensitivity, what makes yields go up and down, especially looking at the characteristics of the building, characteristics of the submarket, and also the economic cycle, are all important skills, if you like, to be able to develop. And some of the hints for those are developed in the study guide. So go back now and look at the study guide and also read the pages of the text in Whipple. There's only a few of them from the text for this week. Most of the text in Whipple is devoted to the discounted cash flow approach, which is introduced in the study guide. We don't really take DCF any distance in this course. We deal with it further in our finance and advanced valuation courses. So we don't need to read the rest of Whipple in this course any further. So you're relieved of very much activity in that regard. However, it's important to really do the field exercises and also look at taking the opportunity to do exercises to try this out with both residential but especially with commercial examples to really get on top of how it works, because it's worth doing a little bit of practice with.